Most investors who read annual reports make the same mistake. They start at one page, they read linearly. They work through directors' reports, the statutory disclosures, corporate governance sections, risk factors, all of it, in the order the document is presented in. And that by the time they finish it, they have spent 4 or 5 hours with the document and extracted maybe 20 minutes worth of genuinely useful analytical information. The problem is not the effort. The effort is real and it deserves respect. The problem is what our annual report the problem is that the annual report is a legally mandated document, which means most of what is in it was written by lawyers and auditors and investor relation professionals whose primary job is not to give clear analytical insight. Their job is to satisfy disclosure requirements, manage legal liability, and present the company in the most favorable light the regulations allow. Reading the document linearly is like trying to understand what a person actually thinks by reading their LinkedIn profile from the top to bottom. The document tells you the company choose to tell you carefully, deliberately after a significant review. In this video, I want to show you what I actually do, which is most which is almost nothing like what most tutorials on annual report reading suggest. I read one section of the annual report carefully. Everything else either scan or specific red flags or entirely skip. And the most useful intelligence I extract about any company um, does not come from the annual report at all. It comes from Concalls. I'm going to walk you through my complete process using Indigo Paint's annual report as a live example because it's a company I've covered in depth on this channel, and you can see exactly how this reading process fed into my investment thesis I built on that position. And I won't do any red flag analysis right now because that is a completely different thing. And right now I'm just reading. Right now the main thing is to read the report and understand what the company does, or to get an idea of what the management thinks, not the red flag analysis. That's a completely different thing that requires the annual report. But yeah, I'll maybe cover that in a different video. So yeah, let's start with section 1. um and this section will cover what I actually read. This is where I start. I'm just gonna go to okay, so let's go to MDNA. Okay, 47. Yeah, right there. No, that's 66. You see, you don't look at this, you look at this right here. So we go back 60, 47. Yep, management discussion. This one. Yeah. The management discussion analysis section, the MDNA. Everything before it, director's report, the corporate overview, the statutory disclosures, everything. I've scrolled past everything. Not because the content doesn't exist, because either formulaic, legally mandated, or available in useful form elsewhere. Or right now it's not really the purpose of the video. Right now I'm just like covering the basics, or the basically broad market, the broader annual report, not the specific red flags and all that. And I read it looking for four specific things, not everything, four things. The first thing, how management describes what went wrong. Now, what went wrong? How they describe it. So we go to, so how okay. So look at how the management characterizes challenging periods here. Um, they attribute the underperformance or the modest revenue growth to, they say, manufacturers passed on the benefits from the softer prices for crude oil linked inputs. Amidst heightened competition, the cost of most raw materials, particularly crude based derivatives like blinders and solvents, along with titanium dioxide, have stabilized. So they're basically saying that there is some spe- they're basically saying that there still is some pressure, but the cost and all of that, the raw material costs have stabilized. Um, now now you should always look for the macroeconomic conditions, which I think they will show you over here in the global side, right here, outlook. They will show you here, and there too it India's outlook, and here climate concerns, all that. Now, vagueness is a warning. When explanation for underperformance is consistently external and consistently non-specific, challenging environment, headwinds across industry, demand softness, you are reading a management that either doesn't understand why their business underperformed, or understands it perfectly well and is choosing not to tell you. So you'll have to read this whole thing. I would recommend you to read the whole thing, to understand why this happened. Well, not the economic, not this, because every company, well, you can read it once of you can read it like every so you can read it in one annual report, and then you'll be fine, because every company basically copy paste the same thing. And outlook, you can maybe read it it's if you think it's going to be different. But yeah, Indian economy, every company pays the same thing. So maybe you can read it once or twice, and then you can skip the rest. But you should definitely read the industry overview and this demand drivers too. Um, the second thing I look for is whether the man the forward guidance is specific or vague. This section is where most investors read looking for optimism. I read looking for accountability. Management, if the management says we expect improvement in coming quarters as market condition normalize, the management has said nothing. There is no target, no timeline, no mechanism, no conditions under which they could be held accountable to that statement. It is a forecast that cannot be wrong, because it commits nothing. So now, um yeah, if the management says we expect EBITDA margins to recover, um for towards the 20 range in H2 FY27, driven by normalized titanium dioxide prices, improving channel mix from our northern market expansion, and operating leverage from the Jodhpur plant coming online. The management has a falsifiable commitment with named drivers, like we saw here. Um, Let me just zoom in. Demand drivers, yeah. Like the demand for India's waterproofing market is rising tandem with development in residential real estate sector. 40% of the nation's population will reside in urban areas by 26. All of this will help you with the analysis and the future outlook, and you should really think about the management's mindset, and like, are they trying to hide things from you, or are they taking the accountability if something is wrong? That specificity and creates accountability that carries across every subsequent con call and quarterly result. I write down specific guidance when I find it in an MDNA and then track delivery against it, quarter after quarter, as a part of my monthly portfolio monitoring. And sometimes you have too many stocks. Like, I have 25 stocks. I can't monitor them all every month. So like, I do it in sections. So for 1 month I'll monitor ABC, and then for month two I'll monitor the XYZ. So that creates less of a pressure. And yeah, um if the guidance in this document is vague, I know that too, because vague guidance in a document management controls entirely, while potentially delivering specific guidance in call under analyst pressure. That gap is itself informative. It means management is more comfortable being accountable in real time than in print. Sometimes that reflects genuine uncertainty, sometimes it reflects strategic communication management. Either way, the gap is worth noting. The third thing I like to look at is asset asset allocation language. Let me see if I can find it here. Like, you can see if they're accountable here or not. Like, that really helps. All these challenges and all. Okay. Like right here. So if the okay, so let me just see if it's around here or not. Revenue, raw materials, cost, human resources. So maybe you can look at here, and yeah, you can look at capital allocation language here, and you just have to look around all of the information. Like, you imagine you are a detective looking into something, so you have to basically look and pick out information. Risk mitigation, you have to look at that too. Anyways, let's get back. So yeah, um asset allocation is what the management is spending money on, and why and what point in the cycle. This is where Indigo Paint's MDNA is particularly interesting. The Jodhpur manufacturing plant, I think it was here. Yeah, yeah, right here. A 90,000 CLPA water-based plant, trial production expected in June 2026. This is significant capital commitment made during the tough sector downturns. Management's explanation: of that decision in the MDNA tells you something more important than how they think. Um, are they investing countercyclically because they believe that the downturn creates a capacity timing advantage, building when construction costs are lower and plants will come online just as demand recovers? Or are they investing because the expansion was planned before the downturn and they are committed to regardless of that changed conditions? I think they should they should like the board report. No, we don't read that. At least not right now. We don't. At least we don't read that right now. So yeah, you'll have to look through it and see what they say. Like in investing, you should build a habit of reading. Because sometimes in hectic days, you'll have to read 100 plus pages. It's gonna be rare, but it's gonna happen someday. Okay. The first explanation reflects capital strategic capital allocation. The second reflects sunk cost thinking. Reading the language carefully, managers who are genuinely thinking strategically about countercyclical investment will say so explicitly. They will explain the timing rationale, not just the capacity rationale. Managers who are committed to a prior plan will describe the investment in terms of capacity, need, and cost without referencing the timing advantage of building it during the trough. Fo- Fourth thing is the forcing is the most underrated reading skill in the entire process and the hardest to teach because it requires you to have prior expectations of what should be there. Before I read the MDNA, I have a list of topics I expect management to address based on what I already know about the business and the period. Product categories that were under pressure, geographic expansion plans that were discussed in prior years, competitive responses to named entrants. If those topics don't appear or appear only briefly without substantive discussion, that absence is more informative than three paragraphs of explanation would be. In Indigo Paint's case, I'm specifically looking for how management addresses the competitive entry of Grasim and its impact on differentiated product categories. If that discussion is thorough and specific, I learned something. It is brief and general, I learned something different. If it's absent entirely, um, I have a question for the Concall. And that question generated by MDNA doesn't say is the most valuable output of the entire annual report reading process, not the conclusion, not questions. The most valuable output of this entire reading process is not conclusions but questions to ask for the Concall. Four things: how they describe what went wrong, whether guidance is specific or vague, what capital allocation decisions reveal about management thinking, and what what's what's conspicuously absent. Every Everything else in the MDNA I read at skim, absorbing the general narrative, flagging anything that seems inconsistent with prior years or with my own understanding of the business, not treating it as primarily analytical content. Because the primary analytical content is not this document, it's the con call. But first, let me show you everything that I skip and why. Okay. Let me show you what I move through quickly. Explain precisely why each section gets less attention. So let's just scroll back and go to contents. Contents and director's message for number 4 here. 124. Okay. Yeah. Director's report, formulatic, legally required. Every company produces one, and every company produces one that sounds largely the same. Operational highlights, dividend discussion, statutory acknowledgements, future outlook stated in the most defensible language possible. I scan it in 60 seconds, looking for one thing: whether your tone is materially different from the previous year's director report. A sudden shift in how the chairman or the MD addresses shareholders, how confident or cautious, or from cautious to aggressively optimistic is worth noting. That that no tone shift sometimes analyze signals something that numbers haven't fully reflected. Everything else in this section I'm moving past. Now, corporate governance section. Let me just find that. Alchemy business model. The corporate information statute. Corporate governance report, page 77. Okay, so 77. Can we click here? No. So last time I checked, it was around 45, and then 45, 77. Yeah, pretty close. 77. Yeah, here. I spent approximately 2 minutes here, not reading, scanning, three specific checks only. First, auditor qualification. If statutory auditor has issued a qualified opinion on an emphasis of matter paragraph, I stop, read carefully. Clean unqualified audit is table stakes. It tells me nothing positive about the business. Qualification tells me something potentially important about accountability liability. I'm looking for anything unexpected: transactions with entities controlled by promoters, management that seems commercially unusual, loans, guarantees, asset transfers, non-market terms. Are governance red flags and deserve investigation. The Rajesh Expo position I discussed in the previous video on this channel um, is one of the most visible signals. I should have investigated more carefully. It was exactly here. I didn't. That's a lesson now. It shapes how I approach the section on every name. I can actually maybe look at related party here. I think it show yeah, it's there. It's right there. So you can see it says related party salary here, dividend paid, all of that stuff. It discloses right here. And if you want to go something, if you want to go in detail, you just go here and see what you want to go in detail, and then just control F it there. Just search it up there. The third thing I'm looking for is board composition. And how many independent directors, how recently appointed, do any of them have backgrounds that suggest genuine oversight capability versus ceremonial presence. I'm not reading a full biographical note. I'm just scanning for independence and credibility. 2 to 5 minutes, three checks, and then I move on. Risk factor. I almost skipped this entirely. Let me just see where risk factors are here. We go back to this business notice. Do we have risk factors here? Risk factors. It's probably here and somewhere in this report. A risk is mentioned all. It's probably hidden somewhere here. Um, but yeah, risk and control, risk management policy, all of this stuff. No, that's there. Risk management committee. So basically, risk factors. Um, I think it's usually mentioned there. I'm not sure if it's here or not. Yeah, I skipped this almost entirely, and I want to explain why because it sounds counterintuitive for someone who spends significant time on risk assessment. Risk factors section is usually written by lawyers. Its purpose is to protect the company from future legal liability by disclosing every conceivable risk, however remote, in language board uh, board broad enough to cover the company if any of them materialized. The result is a section that lists every possible thing that could go wrong: competition regulation, input cost, currency, weather, geopolitical events, without any indications of which risks are material and which are remote. Um, reading this is um, okay. Reading this section is a genuine risk analysis produces noise, not signal. So I basically just skip this entirely. The third and last thing I look at, the third and last thing I'll skip is financial statements. I don't need to look at financial statements here. I can just look at it. Let me just pull up financial statements actually. Yeah, I think it was here. Yep, around here. Yeah, standalone notes and account. Okay, notes to financial statement. Okay. Yeah, so basically financial statements. Um, I scan. Okay, yeah. I pulled these from mostly screener dot in. Not gonna lie, because this is probably the best and gives the most amount of data. Whatever I'm working that day formatted into 5 year um corporate spreadsheet I build myself. Reading financial statements from annual reports in PDF is slower, less comparable, and less usable than having a 10-year data right in front of me in Screener. I only use that when I only use the financial statements there when I have to look at something in detail. Let's say I have to look at balance sheet. I usually use it for the balance sheet. So let's say I have to look at borrowings or the current assets. Balance sheet. Let's just search balance sheet. Balance sheet. 34 only. So this is gonna be easy. 58. Okay. Standalone balance sheet. That was standalone. Let's look at consolidated if there is one. Okay. Oh, wait, right there. Right there. Yep. So I just look at this, and if I want to look at current assets or something like that, and I have to go in detail like goodwill, I have to do goodwill or anything like that, I just do that here. If I can't find like all of that in Screener. So that comparison is not laziness; it is an allocation decision. Every minute I spend on reading legally mandated boilerplates is a minute I'm not spending on con calls, which is where the genuinely unscripted and genuinely revealing communication from management actually lives. Okay, so let's go to con calls now. What we'll do is we just go to Screener, and this will show up, and then you just click to documents or you just scroll down, and then you go to Concall. You can either read the summary or listen to the recording. This is the investor presentation. So this will basically be a PowerPoint presentation on how the business went, all this stuff. You can look. So what happens is, the management give you this presentation before the con call happens, so you can go through this all and then ask questions. But so you can go through this too if you want to ask questions, and then you just and if the con call already happened, then you can just go check the transcript. Okay, so let me show you three main things I listen for in a con call. Well, the whole con call is important. Like, the for example, what I do is, if I don't have time, leave the I'll just leave the this thing. But honestly, if you don't have time, then listen to the recording and read this while doing that. So just if the recording says portfolio diversified, just like go on and do this like this. And if you have trouble understanding anything, just go pause the recording, search it up, and then go forward. But the best form for doing this is reading. Anyway, so if you don't have time, you can listen to the recording, but I recommend you reading it. But yeah, this whole thing, the first few minutes, like 10 minutes or 20 minutes, what management does is management explains what happened in the business this quarter. All of this, management is explaining what happened in this quarter and whatever, and like, are there any major developments and all. This all is scripted. So the management will say what is written down there. Now, if you see Asian Paints, a big problem with these guys is these guys spend, like, let's say Asian Paints, okay? Asian Paints spends like 25-30 minutes of a con call in just going through all of this. So a management shouldn't really uh, do that also. But I understand that Asian Paints is a big business. It has multiple verticals, so they have to go through it. But yeah, so like, it's like, look at this. For example, when did the question start? The question started to the whole so the whole from 1 to 19, or from 1 to 18. What happened was the management was explaining the whole business, and what this did was, this gave the analyst so much information that the analyst some analysts may have forgotten their questions, or like may have just like said that, like, may have just left the call or something. Like, let's see how big the recording is. It's 1 hour. So it's 1 hour it's a 1 hour long recording. Out of this 1 hour, approximately 40 to 30 minutes, eh, maybe even like 40 minutes, yeah, 40 minutes, Asian Paints will just sit and talk about the business, and then the rest 20 minutes will be question and answers. So that's a big problem, you see. Like, a management shouldn't do that too. For okay, anyways, so yeah, let's get back to the topic. So um the first thing I look for is how management responds to pushback. Now, I couldn't really find pushback in this call, but let's say when an analyst challenges a specific number, margin guidance or volume growth assumption, capital expenditure timeline, management has two possible responses. They defend the number with a specific data, a named driver, a quantified approach, assumption, a referred reference to a specific operational development that supports the guidance that defenses um, that defense delivered a specificity under real-time pressure in one of the most credible signals of management confidence I found in investing. Like for example, in HDFC AMC, HDFC AMC, a frequent question that I've seen is being asked in many of the con calls is your margins are dropping. Margins are basically margins of AU of sales over AUM. Like those are dropping, and they're less than last year. So like, what's the problem and all that stuff. And and what these guys always respond with is a very is a very specific and deliberate um answer. It is that if AUM grows, the sales will decrease. No, not the sales will decrease. Sorry, the margin will decrease, cause of a specific what is it called? I'm forgetting the name of it. I think it's mentioned here because like it's a really important metric. Hmm, say classification, all that. No, it's gonna be mentioned. Okay, yeah. Uh, it's a really it's a really important metric. So you basically okay. So how do I explain this? It's the maximum expense that a fund can charge from an investor. So that's SEBI has made a guideline if, that you can use this formula to get that out. So if the AUM increases, that will automatically decrease. But that doesn't mean the sales also decreased because the AUM increased. So even if, let's say your AUM was 50,000 CR, and you got 1% of the profits out of that. So you will have 500,000 500 in sales. But now your AUM became 70 CR, and you only got, let's say, 0.75% of the profits. 0.75, 70,000 or 70 lakh, 70,000 50 0 point, oh yeah, sorry, do that again. 70,000 and 0.075. Even if it becomes 0.75, the sales will still increase. So the management always explains this, and it's a really important thing for the management to do um because like it responds to pushback really well. But a second approach some managements choose is they can retreat to a language that sounds like the answer but isn't one. We remain confident in our trajectory. Medium term outlook is positive. We are monitoring situations closely. These responses delivered in place to or specific data when a specific question was asked um, are a signal, not necessarily a red flag. Sometimes genuine uncertainty is the honest answer, but pattern matched across multiple exchanges in the same con call, they have something about how the management thinks about its own forward visibility. Now, the second one is a question where management deflects. Now, let's say let's say an analyst says, how is your pricing strategy, or like something like that. So like if a management deflects a commercially sensitive question, it's not um, it's not really a problem because it's a commercially sensitive question, and you can't really answer that honestly. And if you answer that honestly, the your competitors might get a clue, and it will not benefit you. But I know that every deflection and across mu- but I note every deflection across multiple con calls. If the same category of questions consistently receive deflections while other categories receive specific answer, that pattern is informative. For Indigo Paint specifically, I'm listening to how management addresses questions about competitive dynamics in differentiated products categories, metallic emulations, tile core emulations, the segment where Indigo holds 80 to 90% market share. If analysts are asking about competitive entry in those categories and management deflecting, that is a different signal than deflecting a question about near-term pricing strategy. The content of deflection, what specifically is topic what specific topic management consistently avoids committing to, is as important as deflection itself. Now, mm, we go to the opening remarks. Mm, yep, right here. This is Indigo Paints, right? Yeah, this is Indigo Paints. Um, okay, this is good. Okay, the main thing is this. Yeah, the third thing, a language a language shift between a prepared remarks and Q&A, the most subtle of all three signals, and the one that makes multiple con calls to calibrate correctly. Management's prepared opening remarks are almost as curated as the annual report. The CFO or MD reads the script, highlights the quarter, reiterates strategic priorities, frames the results in the most favorable available narrative. The Q&A begins as and something shifts. The language um, becomes slightly less polished as um, sentence construction is less precise and the tone changes. And within that shift, you're listening carefully. If you're listening carefully, you can hear where confidence is genuine and where it is performed. A CEO who speaks with equally specificity and composure in prepared remarks and the Q&A is a CEO that again, a CEO who speaks with equal specificity and composure is a prepared remarks is the CEO. And let's do this again. A CEO who speaks with equal specificity and composure in prepared remarks and the Q&A is a CEO who genuinely believes what they are saying. A CEO who is fluent and confident in prepared remarks, but notably more cautious and more general on specific Q&A topics, is more cautious and worth worth noting. It tells you there are topics management is less certain about than their prepared remarks suggest. Um, and I want to say one more thing. So if the pre- so like even if the prepared remarks um, are curated and scripted, you should still read them because it gives you insight on what management thinks and the insight on the business, which you won't necessarily get through going to screener and just looking at the results. So you should read the prepared remarks too. And so after reading the prepared remarks, you'll have a better understanding and a context for the Q&A. And also, like, I want to show you one more thing in the Q&A. If you see this, let's go to this example of this analyst, Abnish Roy. He asks one question, the management replies. He asks another question, so the management again replies. He asks the third question, the management also replies. And then he asks this question about the new appointee, or her, and her or him. He also replies to this. And then and then he asks the fourth question. So what happens here is, when an analyst asks four or like three, even three questions, or even two in some cases, when an analyst asks these questions, the management goes off track. Not off track, well, they go off script, like they don't have any script no more, because the first question they may have prepared something to deal with it, but like now, as the follow-ups go on and on, the management doesn't have the preparedness to do with that. So the management is um, basically going off of its business knowledge and what it knows about the company. And this shows and if the management is still specific and still answers the question like they did before, this shows that the management understands its business very well, and the management is really, in a sense, good and open to share what the business does, and it's not hiding anything. Because if it's hiding anything, you'll find that out before using my previous clues. Anyways, now I want to address something more practical, because con call transcripts are not always easy to find for smaller companies. Like audio quality on recordings call is sometimes poor. Three sources I regularly use is Screener.in. It links to NSC and BSC filings where Concall transcripts are sometimes available. Trendline has Concall section that aggregates transcript for many listed companies. The company's own investor relations page. Most mid and large cap companies upload their transcripts and presentation slides of their con call within a few days of the call. And you can go to concall.in too. I think it's called concall.in. Concall.in. I'm pretty sure it's called concall.in or .com. Maybe not concall.in. Concall India. Yeah, concall.in. It's called concall.in. So you can go here too. Here, you can find multiple con calls and all of that. This is specifically made for con calls only, so this is a powerful tool too. For companies where no transcript is available, I listen to the audio. It takes longer, but it is worth it. The three signals I've described, pushback response, deflection patterns, and language shift, are even more audible in actual voice than the transcript. Let me connect this back to Indigo Paint specifically, because I want to show you how this con call process fed directly to the investment thesis. The confidence with which management discussed the Jodhpur plant timing in recent con calls, specific commissioning dates, name capacity, figures, trial production milestone, was a meaningful input into my assessment of the management's execution. Credibility, specific guidance delivered verbally under analyst pressure, matched against matched against subsequent delivery and quarterly results. That pattern across multiple con calls built a picture of management team that tends to say that they mean and deliver what they say. That assessment, built from Concall analysis, not from the annual report, is the key input into question 3 of my turnaround checklist. Has management generally changed, or in this case, has management demonstrated capability under adversity? The con call is the primary evidence of for that conclusion. The annual report is secondary. I should actually change the title of this video to "How to Read a Con Call" from "How to Read an Annual Report." The annual report tells you what management chose to tell you. The con call tells you what management reveals when they answer questions they didn't write. Both matter, but if I had a choice, if I had to choose one, I would choose con call every time. Let me leave you with the reason this entire process exists. It's um, not to read more thoroughly than other investors. It's not to extract every piece of information company has ever disclosed. It's not to become an expert in annual report formatting or Concall transcript analysis as ends in themselves. It is to answer three specific questions more accurately and more quickly than the market consensus. Why the business decline and is why did the business decline, and is the cause fixable or permanent? Has the management responsible for the problem demonstrated genuine capability or genuine replacement? And is there early execution evidence that recovery is real rather than just announced? Or did the recovery happen but the stock price is still down? Then that creates a asymmetric, almost arbitrage like, but with more risk returns. Um those why okay. Um those three those three correspond directly. Question 1, question 3, question 1, 3, and 5 of the framework I used for every turnaround position. The MDNA reading, the governance scanning, the con analysis, all of it is in service of those three answers, not in service of comprehensive knowledge, not in service of specific analytical conclusion that either supports or challenges the investment thesis. Here's a practical thing I want you to take from this video before our next investment decision before your next investment decision. Pull the last three Concall transcripts of your company. No annual report, it's a Concall. Navigate directly to the Q&A sections. Read only those. Note or questions receive specific answers, and what questions receive deflections. Note whether the confidence in the Q&A matches the confidence in the paper in the prepared remarks. And if you don't understand what a question says, just copy the question, go to Claude or ChatGPT or whichever AI you use. Tell the AI to um, give me a simple but brief summary of this question in your preferred language. So let's say if you speak Hindi, you say Hindi. If you speak French, you say French, and you say like a fifth grader or a fourth grader, like I'm fifth grader, and the Concall and ChatGPT or Perplexity would give you the analysis of it. Like let's just go to Perplexity, Perplexity, Perplexity AI. perplexity. Yeah, let's go through. Let's go to a. No, okay. Which question should we pick? Let's pick this one. Actually, let's go down and pick a random question. Hmm. Nope. Okay. Paste. Okay. No. No. I am giving you giving you the a question from Indigo PNTS for April April 2026 Concall. Answer this in simple. Um, Explain what he says in simple terms. Why, like I am a seventh grader student, and then write the question. And then it will um and then it will say this. He's okay, so he's asking for plain English. Okay. The com okay. The company says sales have been growing in double digits lately, but the reported question is this. Okay, we just do that. Okay, now say it in Hindi. English. Now we'll say it in English, and then you can do that. What about this? Mm, let's say we go to the answer now. We just copy paste the answer, and I don't recommend you copy pasting. I just want to tell you that, like, if you don't understand it, then what to do. Tell me what the answer means. Not a summary, not us. Just the answers in just the answers. Just the answer in simple words. And then we just do that. And then he says this, and then you can just talk to him and like do all of that stuff. Okay. Yeah. So that 1 hour to like 1.5 hour exercise will tell you more about the management quality, forward visibility, and the credibility of recovery narrative than the full linear read of the annual report would ever. Like, let's like would you want to read a 254-page annual report and just learn two three things? Like, no, right? i rather spend that I rather spend that like 4 or 5 hours reading business reports or like something else, or doing fundamental or technical analysis in this company. The annual report tells you what management chose to tell you. The con call tells you what management reveals what they have to answer the questions they don't write. Use both, but know which is doing the heavier analytical work. Just the process the capital will follow.